All right, let's get right into it. We are doing a very granular, really technical deep dive into 529 plan distributions and, of course, the reporting that comes with them. This is for all you pros out there who have to wrestle with the details of Form 1099-Q and make sure every single dollar is reported correctly. We're going straight to the source here, the Internal Revenue Code and the official IRS guidance.
And this quote right here, this is the core principle that guides everything, and I mean everything we're about to dissect. The idea is simple on the surface: tax-deferred growth and then tax-free withdrawals for qualified expenses. But that simple idea is the bedrock of the entire 529 plan structure. It's exactly why all these rules for distributions and reporting are so specific and why it's so critical to get them right. Every calculation, every compliance step, it all flows from this one concept.
So here's our game plan. We're going to start with the legal foundation, right in the Internal Revenue Code. Then we'll jump to the practical trigger for all this paperwork, Form 1099-Q. After that, we'll nail down exactly what counts as a qualified expense, walk through the precise math for figuring out any taxable earnings, and then finally, we'll close the loop and show you exactly where this all goes on the tax return. It's the complete journey of compliance, from start to finish.
Okay, first things first. Let's start with the law itself. You see, to really get a handle on the reporting, you have to understand the statutory framework and, just as importantly, how it's changed over the last couple of decades.
So let's go back to 1996. That's when Section 529 officially became part of the Internal Revenue Code. The initial goal was really straightforward, but honestly pretty powerful. Give families a way to save for college where the earnings could grow without being taxed along the way. But as you're about to see, that was really just the beginning of the story.
The evolution of the 529 plan has been pretty incredible. The really big jump happened in 2001 when EGTRA made qualified distributions totally tax-free at the federal level, a huge change. Then, in 2015, the PATH Act brought the rules into the modern age by adding things like computers and internet access. The TCJA in 2017 blew the doors open by allowing funds for K-12 tuition. And then, most recently, the Secure Acts have added a ton of flexibility, allowing money to go towards student loans and, in what is a total game changer, for rollovers into Roth IRAs.
Okay, so that's the history, the why. Now let's get into the practical side of things, the how. And the central piece of this whole puzzle, the document that kicks everything into motion, is Form 1099-Q. It is the trigger for all tax considerations. So who's on the hook to file this form? Well, that responsibility falls squarely on the 529 program administrator. And listen to this, the trigger is any distribution. I'm not just talking about cash withdrawals. It includes things like tuition credits or waivers too. And here's a major heads up for all you program administrators. Thanks to the Taxpayer First Act, starting in 2024, if you file a combined total of just 10 information returns of any kind, Wadritus, 1099-ints, you name it, you have to file your 1099-Qs electronically through the IRS's IRIS portal. That's a huge change from the old rules. Now, one of the most critical, absolutely crucial fields on that 1099-Q is who's listed as the recipient. This is way more than just a name and an address. This designation literally determines who is legally responsible for any taxes owed if some of that distribution isn't qualified.
And this is where the strategy really comes into play. The IRS has a very clear hierarchy here. If the money goes directly to the student or to their school, the student is the recipient, period. But if the money is paid directly to the account owner, well, then the owner is the recipient. And this has major tax consequences. Why? Because the taxable part of a non-qualified distribution is taxed at the recipient's marginal rate. You know, a lot of the time the student is in a much lower tax bracket than the parent or grandparent who owns the account, making this a really powerful tax optimization tool.
So when you get that 1099-Q in the mail, there are 3 boxes you need to zoom in on. Box 1 is the gross distribution. That's the total amount you took out, the whole shebang. Box 2 isolates just the earnings portion. That's the part that could be taxed. And Box 3, well, that's your basis. That's just your original contributions coming back to you, and it is always tax-free. Okay, so we know that those Box 2 earnings can be tax-free. But how? It all comes down to one single test. Was the money used for qualified expenses? So let's define exactly what that means.
The magic term you need to know is Adjusted Qualified Education Expenses, or AQEE. And look, it's not just the total bill you get from the college. It's the total of all your qualified expenses minus any tax-free money the student got, like Pell Grants or scholarships. That final net figure, that's the number you're trying to match your 529 distribution against.
Now, the list of what actually qualifies has gotten a lot longer over the years. You've got the usual suspects, right? Tuition, fees, books, room and board, as long as the student is enrolled at least half-time. But like we saw on the timeline, different laws have added technology, up to $10,000 a year for K-12 tuition, costs for apprenticeships, and even up to a $10,000 lifetime limit for student loan repayments.
Now, this brings us to a really critical point, the no double dipping rule. And the tax code, specifically IRC Section 529, is crystal clear on this. You absolutely cannot use the same exact expense to justify both a tax-free 529 distribution and to claim an education tax credit like the AOTC. It's one or the other. So any expenses you use for the credit have to be subtracted from your total qualified expenses when you're calculating your AQEE for the 529 plan.
So what happens if your distribution ends up being more than your adjusted qualified expenses? Well, you can't just say, oh, the extra was just my principal. Nope. The IRS says you have to use a very specific calculation method called the Pro-rata Rule.
And here's the key takeaway, pulled right from IRC Section 72. You do not get to pick and choose. Every single dollar that comes out of a 529 plan is treated as a mix of earnings and basis, and that mix is in the exact same proportion as the entire account at that very moment. This pro-rata allocation, it's not optional. It is mandatory. IRS Publication 970 gives us the official 4-step formula to figure this all out. Step 1, you calculate how much of your withdrawal was your original basis. Step 2, you figure out the earnings portion. Step 3, this is the important one. You calculate how much of those earnings are tax-free by applying a simple ratio of your qualified expenses to your total distribution. And then finally, step 4, you just subtract the tax-free earnings from the total earnings to get your final taxable amount.
A formula is one thing, but let's actually make this real. We're going to walk through a concrete example right out of Publication 970 so you can see exactly how these numbers work together in the real world. Okay, let's just follow the math. In this example from the IRS, someone took out $850. Step 1 tells us that $708 of that was their basis coming back to them. Step 2 isolates the earnings at $142. Now, here's the key part. Step 3. Their adjusted qualified expenses were only $700, so we multiply those $142 in earnings by the ratio of 700 over 850. That tells us that $117 of the earnings are tax-free. And the final step, step 4, is easy. Total earnings of $142 minus the tax-free portion of $117 leaves a final taxable amount of just $25.
And there you have it. The taxable amount is just $25. Now, yeah, it's a small number, but it's the process that really matters. Following these steps precisely is the only way the IRS will accept for correctly figuring out the taxable portion of a distribution that isn't fully qualified.
So that brings us to the final step in our journey. We've done the math, we've figured out the taxable income. Now, where in the world does this $25 actually go on the federal tax return?
Well, the reporting is very specific. Those taxable earnings, our $25, go on Schedule 1 of the Form 1040, right on line 8Z, for other income. But wait, there's more. In most cases, that amount is also subject to an additional 10% tax. You calculate that penalty on Form 5329, and then you carry that final penalty amount over to Schedule 2 of the 1040. And that leads us to a final, pretty big thought. The fact that the Secure 2.0 Act now allows for rollovers to Roth IRAs really changes the entire strategic landscape. It forces us as professionals to ask a really important question. Is the 529 plan still just a college savings tool, or has it evolved into something much, much bigger? A flexible, multi-generational wealth transfer vehicle that demands a whole new level of strategic planning? That's a question I think every tax professional needs to be asking right now.